Connect then with Nitin Aggarwal, who is now joining in, head of BFSI Research of Motilal Oswal Institutional. Thank you so much for taking time out. Let's just talk about the overall outlook within the financial space, because the key theme at play in FY24 is expected to be NIM and spread compression. How much of that is really playing out? Who do you see as some of the key winners within this environment?
Yeah, sure. So thanks for having me. And this quarter, of course, is going to be important because last few quarters we have been margins moving one way up for the sector. And we think that this trajectory is now set to reverse, and we will begin to see some moderation in margins for the large private banks and some of the select PSBs also. And thereafter, we expect this fall to accentuate in the second quarter, when the repricing will likely be at its peak for many banks, repricing of deposits as well.
In this environment, Nitin, when right now everybody is fighting for CASA, fight for liability, who do you think will win this war?
So it's going to be remain a tough fight. While if you look at the gap between credit and deposit growth has narrowed already. And we have seen some pickup in deposits and likewise some moderation in credit growth. And the forecast for the year is for a continued moderation on the growth front. But given that the CD ratios for the system is already elevated and there is limited liquidity that banks are now having on their balance sheet. So therefore, to fund the growth, the deposit mobilization is going to be very important, and which is where the large banks are relatively better placed to raise the deposits and fund the growth accordingly. And the mid-sized banks will continue to face some funding cost pressures, and that will have a bearing on the margins that they report.
Every fund house, whether it is a PMS, mutual fund, FI portfolio, they are overweight on financials. Some have 30, some have 35, some even have more than 35% weightage. So the scenario of a benign interest rate, strong margins, decent credit growth, isn't it scenario baked in, which is that markets are factoring in all the good news for next 2 or 3 years for financials now?
I will say maybe to some extent, but the valuations of the financials overall, if you look at, are still fair. Like the sector is today making decadal high ROAs and ROEs. And these numbers are only moving in the right direction. If you look at while the growth in earnings is going to see a moderation now, last 3 years, the CAGR growth itself for our banking universe has been close to 50%. And this number we are now forecasting to moderate towards 20 in the coming 2 years. But 20 per se is still not bad from a point wherein the earnings have already matured. And which is why I think in context to now the valuations, wherein private banks are close to their long-term averages, some of them are trading a lot cheaper also. There is still scope for good returns over the 12 to 18 month horizon.
What has been your take on the Bajaj Finance numbers and even the stock price performance for that matter? Does this now give you conviction that it will continue to dominate?
The numbers definitely were quite strong, and the company time and again has displayed a very strong momentum in terms of business growth. And that has clearly reflected in the price movement on the stock. We continue to like the stock, and while the valuations are expensive, but I think given how the performance has been and the growth rates that they are delivering, the valuation premium will sustain for the company.
And HDFC Bank, that's clearly been in the spotlight of late. Of course, there was the big play with respect to the merger. You had the Q1 updates as well coming in. Is the 18 to 20% growth guidance a concern since they haven't been able to do that in Q1?
So I'll say while yes, Q1 was a weaker quarter, even to our preview estimates that we put out, there was some bit of miss on the business growth front. But as an institution, HDFC Bank has a very long-standing track record of execution. So we cannot really judge the performance on the back of one quarter. But yes, markets and everybody will be watchful of how they mobilize deposits from here, because that will be critical to fund the growth. And also retire the borrowings from HDFC Limited. So the merged loan book, which is over 23 lakh crores approximately, they need like huge quantum of deposits, and that this quarter certainly has increased the ask rate for the residual 3 quarters of the year. which is where it will be watchful, but I think execution has been brilliant throughout, and which is where we continue to like the stock, and I think they will likely come close to the market expectations in terms of growth.
Then what about PSU banks? Because we were just chatting earlier on in the show about how some of these PSBs stack up. And, irrespective of the returns that they may have given in the last 1 year or so, or year to date, the price to book is still very, very cheap.
Yes. So, yes, they have been going through a period of re-rating. The performance over the long period, if you look at, has been quite volatile. And last couple of years, things are moving in the right direction. Most PSBs have now come close to 1% in terms of ROA. And we believe while margins, there is limited scope now for that lever to play out, and OPEX will also be slightly elevated because this full year you will be making the wage provisions. This is started on from November. And now you will be making this for the full year. So that will also be a slight drag on the profitability. But credit cost is still going to be in control. So that is wherein some lever is still there with most PSBs, because net NPA for some of them have already come below 1%. And for the others, the coverage ratios are already very strong, and incrementally, we are not looking at relatively higher slippages versus what we used to. And which is where we think the numbers, the ROAs will continue to hold and probably get better from here marginally. And that will drive further re-rating given where the valuations are for these PSBs.
So if you have to, let's say, make a portfolio which is of you overweight financials, but within that you have to make a choice of overweight private banks or overweight PSU banks, where would you be tilting?
See, this question I'll say would have been far easier last year, wherein PSBs were coming off from a very low base and the earning growth was very, very strong. Now, if you look this year, we are looking at a earning growth for PSBs of around 25% for FY24. While first quarter, the earning growth that we have put out is 96%. So that shows you the extent of moderation that is going to play out. So from a first quarter number of 96% earning growth, this number, as per our projections in Q4, is going to go down to 8%. So it's like a very, very sharp moderation. But full year numbers, which are more important to assess the valuations, there is not very big difference between how the private banks will move and the PSBs. The gap is just 3-4% in terms of the earnings. And which is where I believe the performance within the best of the ideas will be fairly similar. At the margin, we continue to like private banks though, between the two, because they're in the consistency and delivery has been much more. And the valuations also look supportive.
We were debating this yesterday, and I just want your frank view on this SBI market cap and Bajaj Finance market cap. We were debating yesterday that Bajaj Finance market cap is now nearing SBI's market cap. They're both very different. One is a bank, other is NBFC. One has got subsidiaries, other has no subsidiaries. But if I look at the market cap of Bajaj Finance and the profit of SBI and the brand of SBI and the growth of Bajaj Finance, what is right? Will SBI's market cap go higher, or will Bajaj Finance market cap go lower?
So I think Bajaj Finance as an entity has always delivered very strong profitability, and the stock has always traded at a high premium because of the growth rates that they have delivered over the years. SBI, on the other hand, has its own inherent strengths and is one of the best positioned banks within the entire space, as well as certainly within the PSUs. And we are forecasting very healthy ROAs and ROE. Like our ROE projection is close to 17.5% on SBI, and ROAs are going to sustain between 1 to 1.1. And but certainly there is a big gap when it comes to the ROA that you look at between the two entities and the growth also, and that explains the market cap differential wherein Bajaj has come close to SBI now. So I think both the entities from here will do well. We have a positive rating on both the names, but can't really make like a comparison between the two given the differential in the construct between the growth and the profitability.
All right, Nitin, appreciate your time, and always fantastic to have you on ET Now. Let's take